the We company. We continue to track this story. It's rethinking its valuation ahead of its highly anticipated IPO, according to the Wall Street Journal. The parent company of WeWork is considering targeting a valuation of around $20 billion when it makes its public debut. This after the company's last funding round valued it at close to $47 billion. Joining us now is Emily McCormick. Emily, we just had the report out last week that it was considering cutting. Now we get another report that it's considering cutting further. I mean, is this thing ever actually going to come public?
Well, there are a number of red flags that investors and analysts have raised about this company, and this valuation story is just yet another one to add to that list. So that $20 billion valuation would be less than half the $47 billion valuation the company fetched after raising private capital earlier this year. This brings to mind the situation that Uber was in when it completed its own IPO at a valuation of $82 billion back in May. That had been less than the $120 billion valuation the company had reportedly targeted last year, but Uber's eventual IPO valuation was still higher than that of its latest private market valuation. So in that sense, was still in a better position than we're seeing the We company in right now. So for the We company, this is really a reflection of investor trepidation over the sustainability of the company's business model, path to profitability, and corporate governance. So looking first at the business model, the We company rents out spaces under short-term contracts, but pays for these properties under long-term leases. In the process, it's amassed billions of dollars worth of payment obligations. The company has yet to show any signs of profitability under this model. So in the first few months of the year, the We company's revenue doubled to more than $1.5 billion. That was during the first 6 months of 2019. But at the same time, losses grew 25% to $905 million. And then, of course, there are ongoing concerns over CEO Adam Neumann's ties to WeWork, including being a landlord to the company on some of these properties. So no reports or no news yet on the timing of the IPO or the roadshow from the company itself. The Wall Street Journal is saying, though, that this might be delayed until 2020 as the company and its investors and its underwriters work to try and drum up support for shares of the company. Back to you.
Emily, you brought up Adam Neumann. I'm just curious, is anybody saying anything about the fact he took out hundreds of millions of dollars going into this IPO? We still don't have the roadshow, but he took out quite a hefty profit.
Well, that's something that has continuously, been on that list of concerns for the company. It's the corporate governance concern. It's the fact that this is going to have 3 classes of shares and it's going to give super voting rights to its managers and executives. So really a lot of intertwining concerns for WeWork.
All right, thanks, Emily. Let's turn to the panel now. Joining us, Yahoo Finance's Brian Sozzi and Andy Serwer as well. Guys, as we look at this WeWork situation and its ever-falling valuation, I mean, does it tell us something about the broader private market or just about, is WeWork just bad in particular in terms of how it has handled all of this?
It's both. Okay. And we're seeing these companies, these unicorns, each one, Julie, progressively pushing the envelope more and more, asking more of investors. Don't mind 2 classes of stock. How about 3 classes of stock? Don't mind that we're not profitable. How about we're really not profitable? Don't mind some, behavior by the CEO that some people might turn their eyes up about. And don't mind the fact that the pre-IPO valuation is massive. And it's so massive, in fact, that we have to take it down not once but twice. I mean, don't mind all that stuff. Buy the stock. Come on, man.
Well, okay, so I have a question for you, though. If I'm an average investor and I was looking at this, data from SimilarWeb, they concluded in a comparison against Regus, which is one of their competitors at WeWork, that that the company is growing year over year, and that this push they're making technologically, they're trying to create themselves as this kind of integration of tech and real estate. And SimilarWeb is saying they're beating Regus at that. Is that enough to get someone to come in?
At the end of the day, you are watching the destruction of the thesis that it's okay to come to public markets not making money. And in addition, not only not making money, able to convey to investors when you will make money. They are growing. The memberships are growing, but the business model has not proven itself.
I think that's the case, in fact, with all these big unicorns. I mean, that's the only thing we got. Yeah. Is that we're growing. And the whole thing, Adam, is, this is how it works in Silicon Valley. We scale, and then don't worry about it. We'll be profitable later.
We'll be like
Facebook.
Amazon. We'll be like Amazon.
Amazon and Facebook, which are the only, the 2 examples, and there's a lot non-examples.
What about Masasan, though? He bought this on this premise that this was going to be, SoftBank, that they were going to do what Adam Neumann is saying, use technology as well as traditional real estate to beat their competitors and make this profitable.
Well, first of all, I'm not sure how much of a moat, a competitive moat that really is, number one. And number two, SoftBank, understanding their results, I don't know how transparent it is and how many successes and failures they've had. So, that's a whole other issue as well.
I've started to wonder as well, when you look at the WeWork example, as well as some of the other IPOs that we've seen come out this year and fall in the public markets, at what point does this become, if not systemic, more broad-based? If you look at the enormous amount of private equity money that has flooded into some of these things, not just VCs anymore, it's private equity. Maybe it's in your 401k and you don't even know.
Exactly.
What happens if not just WeWork, but you start to see a dramatic revaluation of all of these privately held companies? What is that going to mean?
Yeah, I mean, it could be like 2000 all over again. I mean, I don't think it's as systemic as, say, 2008, but, 2000 was pretty bad, you guys, right? It was a big tech bubble and a stock market crash, and it wasn't a good thing. And you're right. I mean, Sand Hill Road, venture capital used to be a pretty small slice of the capital markets, but to your point, Julie, it's bigger and bigger. And by the way, the VCs have taken all the money out of the game. I mean, I pound the table on this one, but it's really true. They've made all the money. That's why they're called unicorns, because those guys got all the money on the run-up in the private markets.